the basic understanding of liquidity sweep, what it means, why is it important before you start analyzing trade. Some people just think that trade is about drawing different kind of lines on the chart. There's a reason why you need to identify all these things. We all know that liquidity sweep is one of the most important concepts in smart money concepts, SMC or ICT. A liquidity sweep happened when price moved above high and low, right? Let's just assume that this is high and this is low, right? And you know that price always do like this. This is high, this is low, this is high, this is low. So when you see a break above a high and retracements inside, that is liquidity sweep. Let me show you again. It's not really hard to identify. This is a range. This is high, this is low. So you can see that this is the high of this market and this is the low of this market. So when you see price breaking this level and retracing back inside, that is what we call liquidity sweep, or breaking below low and retracing back inside it. That is what we call liquidity sweep. Just think of it as market collecting orders before making real move. So from that statement, you already know that if market wants to go to buy direction, it will first go to sell direction. And if market wants to go to sell direction, it will first go to buy direction. This is liquidity sweep. This is liquidity sweep. So liquidity sweep simply equal to price taking out a high or low to grab orders, then reverse. The question you now need to ask yourself is that why does market do this? You know that we are not the one controlling the market. We have market movers and we have retail traders. So we are retail traders. We are not the one controlling the market because of our capital. But institutions and banks, they have enough capital to manipulate the market. So anytime banks want to buy, they will need sellers. And anytime they want to sell, they will need buyers. So they push price to the areas where many traders are placed orders. This is high, this is low. This is high, this is low. Normally, if somebody wants to set stop loss, this is where you are going to set your stop loss, right? And also place trade for maybe buy. So let's just look at it like this. Let me use a ranging market to explain that. This is a ranging market. You can see high, low. Normally, buyers will want to place trade, sellers will want to place trade here, so that when the price gets here, it will move like this, right? Why buyers will place trade here and set their stop loss here, so that when the price gets to this level, it will move up. So what our institution used to do is that they like taking people out of the market. So by hitting their stop loss, for example, buyers are in the market, sellers will be interested to enter this market, enter the market, set a stop loss at this region, there's a breakout. So you see, buyers will even be overexcited. We place trade for buys and set their stop loss here, but banks or institutions will enter again and take them out of the market before moving to their sell direction. So it is wise that you trade like banks. It is wise to trade like banks. And in order for you to be able to do that, you must always wait for liquidity sweep. So the next thing I want you to know is, why is it important? Right? Why is it important? The first thing is that it helps you to avoid fake out. Like just what happened here. Maybe this market is like this, right? So you see a breakout and you place entry for sell, and the market comes out in, because you already have the knowledge of liquidity. Where anytime there's a breakout, you wait patiently for confirmation before placing your trade. It saves you from jumping into the market at the wrong time, right? And it also gives you information about what institutions are doing. It gives you better entry. It improves your probability. And I want you to know that trading after confirmation, right, follow a liquidity sweep, generally offer a higher probability setup than entry at initial breakout alone, right? And I want you guys to know that liquidity sweep cannot be used alone. There are other things you have to look out for before you place entry in the market, and that is order block and imbalance. So I decided to break them into sessions so that it will be easy for you guys to comprehend. So anytime you come to the market, look out for liquidity sweep. Then after you look out for liquidity sweep, look for confirmation. But let's just look at this chart. You can see that this market is moving in downward direction. You can see there's a breakout here, there's a breakout here, and this I want you guys to be identifying breakouts on higher time frame, 4 hours and 1 day. So you know that this place is the recent high, right? We are waiting for the price to break it. So if the price break it, okay, we say change of character, right? Expecting that the market will be moving in an upward direction. But this price was unable to break this level, and this is the recent low. So we have not yet confirmed yet. Maybe this price will be able to break this level, because this is what we are expecting. This is what we are expecting. A breakout, something like this. But let's see what happened in the market. The market later broke this level and entered again. This is liquidity sweep. Can you see now? Now pay attention to this liquidity sweep. That means we have new high, right? But this high led to the breaking of this low to form a new high, but the high has not yet been formed yet. Now this high is called protected structure high. Why? Because it is not liquidity itself, right? It is not liquidity. It is the high that is formed as a result of liquidity sweep. Do you get now? So another word for it is strong high, protected structure high, or strong high. Now look at this. This is an uptrend market. There's a breakout. This liquidity sweep, this low is called protected structure low. So if I ask you that what is protected low, I believe you know it, right? Good. Okay, look at this also. This is another liquidity sweep, and this is PSL, protected structure low. Protected structure low. Let's look at this. I want you to identify liquidity sweep in these charts. So you can see that this market form a low, form a high. What is this? Very good. Liquidity sweep. It broke above the high and retrace and reverse. This one, what is it? Liquidity sweep. Very good. We have liquidity sweep 1, we have liquidity sweep 2. So this place is called what? Protected structure high. Protected structure high. Now look at this place. What is this place? Very good. This is liquidity sweep. That place is called protected structure low. We have another liquidity sweep here. Protected structure. This is our protected structure low. Let me show you one more example. It's also important that you take into consideration weeks like this. Now, you can see clearly that this market formed a high here, right? Moved to form a low here, and give us this one, which is the high. Then there's a breakout, but there's a shadow inward. When you are looking at this, something like this on lower time frame, you see this place. This is what we have. Something like this. This shadow is liquidity sweep, because when you look at it at lower time frame, this is what you are going to see. This is what you are going to see. If you look at it on lower time frame, that is what you are going to see. So I believe you understand how to identify liquidity sweep in the market.